if you are to group every aspect of due diligence into buckets, right? What would be that sort of bucket system that you're going to have, and what are the different key considerations?
One, you want to look at the thesis of the fund. It's so I think the next phase is like really understanding what problems exist, right? And like understanding why the problems exist. The next question is in terms of the markets, right? And like when looking at the markets, my personal opinion is, I do believe more in taking a bottom up approach to try to do market sizing than taking a top down approach trying to do market. Then the next step would then now be to understand the team that is building it. Basically, why are they building the solution? And how experienced are they to build a solution, right? Generally, what I would say, I've seen is like, investors are more comfortable with founders building in a space that they have experienced
All
in,
right.
not
Hi,
necessarily.
Augustine. It's a pleasure having you here. How are you doing today?
I'm doing good. I'm doing good. And how are you doing too?
I'm fine. So, guys, today we are going to be looking at chapter 4 of the book, and this time around, we are going to be talking about due diligence. And if you've ever been around in the startup space, maybe as a founder or as an investor, one particular conversation that everybody keeps talking about is due diligence, due diligence. And a lot of us might be wondering, what's this due diligence thing all about? So, that was pretty much covered in chapter 4. And today I'll be talking about due diligence with one of the best hands that could actually be talking about this topic, and that's Mr. Augustine. So, without wasting much time, I would just like to hand over to Mr. Augustine. Please introduce yourself and just tell us a bit more about yourself.
Oh, interesting. Name's Augustine Quibrain. I've been in the space for say 4 years, roughly. Started off interning with a venture building firm, and then went to work for a single family office, and now I'm with Global VC, that manages $3 billion in asset under management.
All right, thank you very much for that introduction. So, guys, he has a very well-rounded experience. So, like I mentioned, today we are going to be looking at chapter 4, which is deal screening and due diligence. Now, just to set the tone for things, I'm just going to read like the introductory part of the chapter. It says here that picture this: only one out of 300 deals reviewed by VCs eventually gets an investment, which is 0.33%. The question is, what forms the decision process that leads to the selection of the 0.33% that gets funded? This chapter explores the critical and intricate phases of venture capital, due reviews, and due diligence, where the destiny of investments is determined. Right. So that's just to set the background. So I'm just going to go on. So if you are to group every aspect of due diligence into buckets, right? What would be that sort of bucket system that you're going to have, and what are the different key considerations?
Yeah, like so obviously this is going to be different for different people playing in different fields, but like I think generally, one, you want to look at the thesis of the fund, the sector in which the fund is looking to invest in, because every fund has a thesis. So stage, markets, sector, and stuff like that. And so like really understanding and making sure baseline that those companies fit all those thesis. The next question is, what's the problem? I think the book calls it "unsolvable," which is which is the which is the word for problem in Igbo, right? So I think the next phase is like really understanding what problems exist, right? And like understanding why the problems exist, because it might be a question of, oh, the problems exist, because people haven't like solved it yet, or maybe because problem still exists because maybe people have tried to solve it, but the current infrastructure available is not really supporting the existence of that solution, right? And so like it's not just understanding the problem from like the customer point of view, like really understanding the problem from like the market and sectoral point of view, and being sure that okay, you could actually provide a solution to that problem, right? The next question is in terms of the markets, right? And like when looking at the markets, my personal opinion is, I do believe more in taking a bottom up approach to try to do market sizing than taking a top down approach trying to do market sizing, right? And so in terms of like the bottom up approach, right? Like really understanding, okay, um, what customers would be willing to pay for to get a problem being solved, right? And that's going to be a fraction of, okay, is this solution you've created, is it some sort of like a necessity, or is it like a value addition, right? So like really understanding necessity in terms of, you know, I need a solution, right? I have no other choice. I need a solution. Probably I need to find money to get a solution, or is it, a solution whereby, okay, if I don't have the solution, my life will not necessarily be worse off, but if I have the solution, my life would definitely be better off. I don't know if you get. So yeah, but that's what I mean by,
Yeah, so I
yeah,
got it.
exactly. So that's what I mean by necessity and and a value addition, right? And also, like, again, when you consider that, so I think necessity and value addition will tie into the willingness of customers to pay, right? If it's a necessary product or luxury product, it's basically tied to the willingness of customers to pay. Next is, affordability. So there's willingness, there's affordability. Are they able to actually buy at your price, right? Are you charging a price that is higher than what the competitors are doing out there? And if you're charging a price that is higher than what competitors are doing out there, it might not necessarily be a problem. But the question is, why are you charging a price that is higher than what competitors are doing out there? Is it that competitors are not offering the same service, something, they're not offering the same service that you're offering, they're offering something, different from what they're offering, something better from what they're offering, and you're really sure that there's no way that they can actually up and meet up the standard in which you're offering. So it's fine to actually charge a premium to that, especially if it's a necessary solution. They would be willing to pay a premium to actually get that problem solved, right? The next thing is, like, really, like, again, I think I've spoken to that slightly, but like really understanding, what the most or the differentiating factor is, right? And how strong or solid the moat is, right? Or if it's a mode that is just only present in the short term and disappears in the long term, because at the end of the day, the market will converge to meet you where you are. Or if it's a mode that it's something solid backed, may probably backed by government, and something that you're able to probably build a monopoly around, or whatever the case is. I think that the next step would then now be to understand the team that is building it. Basically, why are they building the solution? And how experienced are they to build a solution, right? Generally, what I would say, I've seen is, like, investors are more comfortable with founders building in a space that they have experienced in, not necessarily, them having to have like built a company or a startup before within that space, but them probably having to, work within that sector, within that industry, and are able to gain that knowledge, are able to, transfer that knowledge, to put it in, how they run their operations, and not necessarily just, how they run their operations, also able to have the network to establish, the first line of sale, to be able to get the first line of um supply to run the business, right? So that's like really another thing that you need to understand. Um, the other thing, I would say, having like put all this in perspective, is then to also consider what the what's the word now? What the terms of the deals are, right? And so, like, when we trying to understand the terms of the deal, right? Okay, no. So before the terms of the deal, right, you want to, like, really look at what the product market fit is, and I want to especially say product market fit is traction, right? To me, simplest definition of product market fit is, like, really seeing that customers are, one, paying for your product and continuously paying to access that product, and the number of customers paying to access that product is actually growing at a very, reasonable and decent rate, right? Obviously, which we drive into the traction, and being able to grow well, right? The next thing would then be, what the terms of the deals are, right? So, like, basically understanding, you know, how much should you come in, into a round, you know, and, what the potential return will be, right? And I think, again, this ties into, um, I wouldn't necessarily say a fund's investment thesis, but I would say a fund's investment, investment strategy, right? So different funds have like different targets in which they would want to come in. But I think the general notion is at least the company should be able to return the fund, right? So if if you are running a $10 million fund and you're investing in the company, right? So the idea would be to be able to return that $10 million fund, right? If you write that check, so maybe if you're writing checks of say 500,000, right? The idea would be that 500,000 should grow and be able to return $10 million, during at the point of exits, right? And so now the question is, for you to be able to return $10 million at the point of exit, right? What needs to happen? Obviously, you need to factor in dilution, but the question is what needs to happen, right? So is company exiting through IPO, will the company exit through M&A, or will the company grow big enough and profitable enough to generate enough cash to actually buy out investors, but also within the considerable time horizon, right? Which is really important to consider when you're looking at this kind of like this kind of like an analysis. And you should also know. So I'm just gonna speak a little bit more on the M&A side, right? Because I think like in Africa, right? There's more M&A in terms of exit than there is in terms of IPO. So like obviously considering okay, who are the potential acquirers for this kind of business, like really trying to understand why they are looking to acquire a particular why they would be looking to acquire a particular business in the market that you're building at, and I think a way to do that is basically to look at their acquisition history. Is this a company that are these companies that have been doing a lot of acquisitions? What are the characteristics of the companies that they've been acquiring? What similarities do you see now, and what similarities do you think there will be like 10 years? It's 10 years time when you're trying to exit the company, right? Um, I think those are like how I just placed them in a nutshell. I
Correct.
think I've spoken too much, but like
I mean, Augustine, you have been very, very, very touched on very, very silent aspects of due diligence, and again, that sort of framework was also part of what we advocated for. That investment thesis is very, very critical. That's always the starting point. Whether this particular investment opportunity you're looking at fits the investment mandate, then we'll start talking about okay, dissecting the problem, trying to know whether it's a painkiller or an antibiotics, then dissecting how well does the solution fit the problem. Do a deep dive into the market, and you made mention of something that is very critical, because a lot of times when you look at pitch deck of startups, what you see is that oh, it's a $5 billion market or it's a $200 billion market, and we just want 1% of that market, right? And the approach generally is they just go online. Oh, what's the size of the pharmaceutical market in the globe? And they just pick 60 billion, but forgetting that oh, that comprises pharmacy manufacturers, that comprises a whole lot within the pharmaceutical value chain, which may not be realistic. So that sort of bottom up approach is always advised, right? So I really do appreciate that. But now again, one thing that especially for founders they tend to complain a lot, especially for VCs that are institutionalized, is that it almost looks like the process of due diligence takes like forever. Yeah, so a lot of times founder maybe due diligence taking 6 weeks, 8 weeks, depending. So from your own from your understanding, so what are those intricate processes in due diligence, right? So in the book, part of what was discussed is some VCs want to go from pre-screening, having calls with founders, from having calls with founders, and now doing a full-blown DD where they are now okay, getting data room and writing an investment memo. Then there is IC. So from your understanding, what are some of those processes and that could impact on the timelines for due diligence?
yeah. So I mean, like I think first of all, right, it's really important for founders to give a buffer when they want to raise. So like not so two things. One, ensuring that you're not raising when you're almost running out of cash. So you must always, have be calculative, have a budget, really monitor your expenses, revenue, every single thing to the latter, right? And being able to project that, okay, fine. It might take you, I think on average, like people would recommend like taking 6 months, right? Ensuring that create a buffer of 6 months to be able to complete your fundraising. It might take longer than that, but let's just say a minimum of 6 months, right? So not raising at the point when you're almost like out of runway, and also raising when you're at the point of almost out of runway kind of like puts you in a bad spot, right? Because you then now become desperate for cash, and you not have the negotiating power, or you not have any form of negotiating power when it comes to to actually striking a deal, right? Especially if the VC is interested, right? Because you're desperate, any deal will look like a good deal for you, which is not necessarily always the case. Um, so that's one aspect. Second aspect is uh, when you've made a decision that you want to fundraise, right? You have to start getting prepared for it. Make sure your data room is like, up to date, it's tidied, every single question, because you need to understand that investors are like external stakeholders. They are not, potential investors are external stakeholders. They're not necessarily part of the business yet. So they don't have the same level of information that you have. So you make sure that all the information necessary for them to actually come to a decision is there. It's transparent, right? Because do not have the idea of okay, some information don't look good, so I'm gonna like not include it in my data room. Investors are not stupid; they will end up asking, um, and then because you've not prepared, it might take time. So um, delays might come from you not being ready and not being prepared during the fundraising process. So you have to actually be prepared. That's one thing that's important. Second thing that is important is actually you know being keeping a very close communication, right? Like responding to emails on times, and just like really updating up all sides of the party with the progress of on your fundraise, right? So which is also key. In terms of like what basically causes a delay during the due diligence process is a number of factors. I think I've mentioned some of them, but like I think the key thing for to like the key thing to actually hasten investment process is actually keeping a very good communication and open communication, one, and also like really asking for transparency. So like not just going to pitch to a VC, but also like really asking them what their process is, because different VCs have different processes. Some are long, some are short, especially if you're speaking to a VC who's potentially going to lead you around. Obviously they would have to do intense DD on you, which can obviously take time. And so you just like need to be on the top of your game. Like when you're in fundraising mode 100%. My personal opinion is that I see some people hire fundraising managers to actually do their fundraising for them, which in my opinion like doesn't I'm not a fan of that. I would say, if you allow me to use the word, I'll just say I think the word is like really take charge of the fundraising process, be prepared, be serious, like have all your documents together, and I give it your 100%, like putting your efforts to ensure that to the best of your ability you're able to close the fundraising on time so that you can actually go back to building a solid business.
Yeah. I mean, you've raised very, 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 very valid. You see the aspect of communication. Let me just start from the first thing you said about early planning. And many people feel, okay, when I get into the market, 1 month, I'm done, then I'll go back into building. Many times it takes longer than that, right? And being able to be investment ready in the first place, because you see a lot of times you are speaking with the founder, and part of what you need to do your DD is you're asking for link to their data room, and it takes weeks before they get back to you with links to their data room. Maybe that's when they're trying to set things up. So that whole aspect of being investment ready is very, very critical. But when you have done all of this, is very much important. Communication is very, very key. Understanding what the process looks like. And in the book, we talked about the fact that the process could be a bit lengthier for VCs that are highly institutionalized. That the decision making is not just entirely within the team. That they have like an external IC and team, right? That's very, very critical as well to understand. So that would sort of give you the an understanding of why the investment thesis is sorry, the DD process is going to take longer than expected, right? So
Mhm.
that helps a lot. The next aspect of the question as we wrap up, because we just have about 6 minutes left. So we've talked about a whole lot in terms of due diligence. Now, for an analyst or an investor, what are some of those skill sets that are necessary for due diligence? Okay, in the book we talked about having a question in mind. Don't just take things at face value. Being able to question, being able to, again, industry understanding, right? Because there are certain nuances around different industries. Unless you understand that industry, you may not be able to poke into certain areas. And that's why you see VCs having specialization. Oh, we are sector agnostic, but let's say A, B, C, D sectors are usually our preference, right? So from their own view, like what are some of those skill sets? What are those some of those skill sets that are necessary for being effective in due diligence?
Um, yeah, so I think again, I think the book covered most of it, right? If not all. Like you said, having a question in mind, always having to question every single data, being able to ensure you understand the data and why the data exists. Where you're looking at numbers, like being able to understand what's really driving growth. Being able to understand why there was a decline in particular periods or particular months. Understanding what's being infused in the cogs, really being able to understand every single aspect of the business. Asking questions around where the co-founder thinks he wants to take the business to, and like why they've chosen to pick that kind of like strategy to be able to drive the business, right? So it's basically your job as an analyst, right? Obviously one, look at being able to like analyze the data. I mean, is in the word, right? And analyzing the data is basically having like a really, really, really deep and intense question in mind. Being able to like really understand, such that you are able to really understand the business just as the founders do, and like really able to understand where the company is going, and like why you think the company will get there.
Right. So thank you very much, guys. You've heard it. Have a question in mind. Have some of domain knowledge, right? And sometimes and again, these things don't come overnight. As you keep on seeing more deals, you tend to build that knowledge. You listen to pitch, you read up stuff about that industry, and you speak to people. It's something I do a lot in due diligence. Is okay. Once I have a particular industry that I don't understand, I call people. I speak to people that operate within that particular industry just to get their own views. So, but then eventually you realize that as as even as much as you can be thorough, right?
Mm,
Certain areas that you possibly will not see issues coming from.
mm,
And that's right. See, part of the ways VCs try to hedge against that is maybe at the point of deal structure, including certain
mm,
clauses, being a member of the board, and having some sort of information right so that they're able to monitor progress. And not to worry, in next episode, we are going to be looking at deal structuring, where we are going to talk about all of
mm.
it. So, guys, thank you very much, and thank you very much, Augustine, for doing this. I really do appreciate it a lot
Pleasure.
that have been shared. So, guys, the book remains 365 Days in Venture Capital. Do well to get your copy, and you can get it on www.365daysinvc.com. You can get it on Amazon. You can get it on Roving Heights. And feel free to send me an email. I would love to hear your feedback. Thank you so much, Augustine, and do enjoy the rest of your day.
Thank you very much for having me.